Hello and welcome back to another episode of In the Money. I'm Konstantin Vrandopoulos with Fidelity's Trading Strategy Desk, and with me, as always, Mr. Tony Zhang, Chief Strategist at OptionsPlay. Welcome back, Tony. It's great to see you. Haven't seen you in a couple weeks.
Yeah, thank you so much, KV. It's been great. It's great to be back. We have a lot to talk about post the election and kind of how we are planning for the market going into the end of the year.
Absolutely. It's been an eventful couple of weeks. I'm very happy to be back to host another episode. Um, I would say that looking at the last week worth of trading, it has been relatively uneventful. Broad-based indices are in consolidation mode, going sideways. I mean, we are getting some two-sided action, both to the upside and the downside, but in a very tight range, especially as compared to the prior week that was very eventful and very one-directional to the upside. I'm very curious, Tony. We don't have a whole lot of time left in terms of trading days until the year is over. I can't believe that I'm saying that here. 2024 is very quickly going away here, and I'm curious. What are the types of things that you're watching going into the year end? Any particular levels on charts? Any specific events that our listeners ought to be paying attention to and putting on their calendar?
Yeah, absolutely, KV. As you said, a lot has happened. But if we first start with just some of the technical levels, you have the S&P 500, which broke out above 5,800 on the back of Trump's victory. What's really more important, I think, for investors is the fact that the S&P broke out to new all-time highs prior to the election, but the other indices, the Nasdaq and the Russell, did not just yet. But the election is really what provided the catalyst for both the Nasdaq 100 and small caps, the Russell 2000, to break out to new all-time highs as well and confirm that all-time high on the S&P, which puts us in a much more bullish tone here in the overall market compared to just a couple of weeks ago when you and I were talking before the election. And if you look at kind of how the market is reacting since the Trump victory, it very much echoes what we saw back in 2016, which is between the election and the end of the year, markets rallied strongly going into the presidential inauguration. And we continue to see the same kind of leadership as well. You have small caps that is leading the markets higher here, financials, industrials, similar to the same sectors that outperformed, in 2016 after the election victory. So for those reasons, I think that, our base case right now for equities is to have a positive outlook going into the end of the year. I think the biggest challenge and the biggest difference between 2016 and now is going to be the fact that 10-year yields are rising. We have 10-year yields back above 4.4%. This is largely based on kind of market expectation that inflation is at the moment still somewhat sticky, and there's a potentially policy that's coming down the line that's inflationary in nature with regards to tariffs and trade and tax cuts. And we've had the CPI print come out yesterday, which showed that while inflation is kind of moving in the right direction, it's certainly a little bit more persistent and sticky than I think a lot of people would like it to be. So that's going to have a risk in terms of what the Fed does going into next year, even though right now the markets are still pricing in about an 80% chance that we get a 25 basis point cut in December. That is still the base case. So the inflation print yesterday didn't really move the needle on that front, but I do think going to next year with 10-year yields at these 4.4% levels, certainly limits the attractiveness of equities, when bonds are still yielding such high yields, and certainly puts some of the concerns around kind of the debt loads on both consumers and corporations and even potentially treasuries into question, as interest rates remain fairly high here. So, we're going into a fairly light period on the economic and earnings calendar period, as we head into Thanksgiving. And, this is really where sentiment starts to be driven off of, who gets to control the House, which just earlier today we saw that the Republicans seemingly have clinched the House as well. And also just, Trump's cabinet appointments. Those are seemingly having some influence as well on sentiment and expectations for how tough the US will be on China, our expectations in terms of tax cuts and tariffs against foreign countries. These are all things that have, fairly inflationary concerns for the overall market. And I think that's what's likely going to be driving the news cycle in the next couple of weeks.
Very good, Tony. Thank you for that backdrop. There was a lot there to unpack, for sure, but we come back every time and try to give you hints in terms of what matters the most. Given that backdrop, Tony, I'm curious, what are you looking at as potential opportunities, and how are you using options to take advantage of those opportunities you're seeing?
Yeah, the first one I want to take a look at is a bit of a longer term view here for investors who might be interested in Intel, because I do think that after struggling for quite a few years now, it is potentially positioned for growth, especially for long term. If you look at kind of the recent restructuring of the company, their cost cutting measures, and despite the fact that their AI chips have not particularly sold well, I do think that you have what looks like the early stages of an opportunity for a long-term recovery that is starting to take shape here in Intel. A stock that a lot of investors did not want to touch for a long time is starting to see some early signs of recovery. So if we take a look at a chart here, this is a stock that peaked back in 2021. It's lost nearly 60% of its market share, but recently, if you look at the chart here, it's clearly showing that recovery is starting to take shape here, because you first broke out above $22, which is the first sign that the stock is potentially bottomed here after breaking below 20 and kind of forming that double bottom there. And now it's broken out above a second resistance level at 24. So we continue to see kind of these higher highs and higher lows that's signaling that a potential recovery is in place towards, at least an initial $30 target. And then above that, we're looking at well back into the high 30s and low 40s. But I think the big story here can be seen through the fundamental lens. This is a stock that's trading at about 16 times forward earnings, which is a pretty substantial discount, nearly 25% discount relative to the industry average. Yet I think a lot of investors may not be aware that, analysts are expecting EPS growth in the north of 40%, revenue growth about 12, 13%. So that's, coming in, nearly double to triple some of the average expected growth rates of its peers, yet it trades at that 25% discount. Yes, margins took a huge hit in the restructuring, but they expect margins to recover back in Q4, which is coming around the corner. So from my perspective, I think that you have a valuation that looks actually quite compelling given the growth rates that we are expecting here for Intel going forward. So I think the way that I want to structure this is a simple long-term, simply buying a call option, an in-the-money call option. I'm going out to the March 21st expiration for 2025, and I'm buying the $24 strike call option. That's an in-the-money call option earlier today that costs around $3.80. What that means is that I'm taking on a total risk of only $380 per contract for every 100 shares. And that allows me to start taking a limited risk stake in Intel's recovery. So this call option provides me with unlimited upside participation while risking a total of only $380 per contract. That's the equivalent of controlling about $2,400 worth of equity shares for only $380. That implies about a 6 times leverage that I get in the upside. And I know a lot of investors might be thinking about leverage as this double-edged sword, but that's really where the limited risk nature of this call option makes sense, because I'm risking only in this particular case about 15% of the stock's value in total for this particular trade, while getting about 6 times leverage over the next 4 months, time going into the expiration in March.
Yeah, Tony, this approach I think is not being talked about often enough. I mean, in the industry, in the trading circles, this strategy, um, sports and name, it's often referred to as a stock replacement strategy. a strategy that obviously does have that limited risk, unlimited potential reward, and gives you the convexity, a way to really express that bullish view in Intel. The stock obviously has been plagued by underperformance. I mean, you compare it relative to its peers or relative to the industry, the sector that it's in, the broad based index, like the large cap index, for example, it's underperforming all of them. It's down almost 50% from its intra-year highs. What we, I think, want to talk about here, Tony, because of the fact that there is a limited risk, and you often allude to the point that if you're a buyer of premium, you're managing your losses at about 50%, regardless of the circumstance or situation. So the risk is defined, and you can even manage it to a smaller loss if you're managing it at 50%. But what often is not talked about is, what do you do if this thing starts actually moving up as you expect and intended to? How do you manage a position like this if you are putting on a stock replacement strategy with pretty large deltas to the upside?
Yeah, thank you so much. That's a really fantastic question. And as you said, we talk about managing risk a lot, and managing risk from my perspective is very black and white in terms of how do you go about doing so. But how do you manage winners? And that's really much more of an art than a science here. There are a lot of different ways that you can potentially manage winners. I think when you have like a high delta approach like this, there are a few different ways that you can do so. First of all, is really having an upside target on the underlying stock itself. So like I said, my initial upside target is around $30. Once it reaches those prices, I definitely want to be considering rolling out my call options to a higher strike price, and that allows me to basically lock in some profits while maintaining further upside exposure. The other thing that I might want to consider doing with these types of structures is that as the stock rallies and perhaps reaches a level of short-term resistance or a period of consolidation, using that period to potentially sell some additional premium against the long call that I purchased to offset some of the time decay that I have. So selling short dated calls against the long dated calls that I own to offset some of the time decay and offset some of the cost of buying that long-term call is a way that you can also further manage kind of the time decay nature that you have to pay when you're long convexity like this through a simple call option. So those are some of the things that I typically would be looking for. And always, on this show, we do these look backs where we look back on previous trades and give you an update on how we're managing these trades. And this is certainly one that we will continue to follow up on and show you how we're going to be adjusting this trade as the stock potentially moves in our favor, or if it moves against us, what we do to close out the trade.
Oh, for sure, Tony. This one's got some time to live, so we'll come back to it when it's cold for when time is due. Thank you for breaking that down in great detail for us. Let's take a look at the second trade idea, Tony.
Yeah, the second one I want to take a look at here is in Meta. What's really interesting for Meta is that, they've really kind of not only rebranded themselves, but really started to expand their business models a bit beyond, just Facebook and advertising. And, recently their advancements in AR have been incredibly compelling for, their future revenue growth. Yes, there are some concerns from investors with regards to the amount of money they're spending in order to seek out that growth in terms of AI. But I actually think a more interesting opportunity here outside of AI for Meta is actually their recent into augmented reality. They recently released Orion glasses that are kind of just a preview of what is potentially here to come, and it seems like they are in a position to directly compete with Apple's Vision Pro. And you think about Apple's entire future to some degree is staked into augmented reality. They've spent over $100 billion in nearly 10 years building their Apple Vision Pro. But if you look at kind of the two products, Apple Vision Pro is not selling well. They're not attracting developers on it, and that makes the product virtually dead in the water. Versus Meta is really making some interesting inroads in this particular space, and I think that they might potentially be further along than Apple might want them to be. So if you look at the stock itself, the stock has broken out above 540 as a resistance level a while back, and it's been forming this base above that level with positive momentum. And that shows me that there's a potential for breakout here to new all-time highs above 600. And more importantly, I think just looking at the business, this is the stock that has industry-leading margins. We're talking about net margins of 35%. Really, there are very few tech stocks that have net margins that high consistently. They're still expected to grow revenue about 23%. I'm sorry, revenues by about 16%, EPS by about 23%. That's head and shoulders above its peers as well, nearly double its industry peers. Yet it trades at only 23 times forward earnings, which is about nearly a 20% discount relative to its peers. So, you have a stock that's growing faster than its peers, it's more profitable than its peers, yet it trades at a pretty substantial discount. And that leads me to believe that there's significant upside above that $600 breakout potential here from a technical perspective. So, the fact that it's still trading in this range between 540 and 600 leads me to take at the moment a more neutral to bullish view here, which is why I think the right structure at the moment before it breaks out is to be a seller of premium here. And I'm going out to the December 27th weekly expiration. And I'm selling the 575 puts and then buying the 550 puts against that. Earlier today, you can collect about $9.80 for that net credit on that credit spread. And the reason I'm doing a credit spread is because if I just sold the 575 put, number one, that would require a substantial amount of margin requirement to sell a put option on such a high price stock. And it would require for me to take on a substantial amount of risk. By using a credit spread like this, I reduce my overall risk to just $1,500, a little over $1,500 per contract in exchange for the potential reward that Meta stays above 575 and I collect that $980 per contract. And it's profitable as long as the stock stays above the current levels around 575.
Everyone in the audience can appreciate the fact that, in these higher price stocks, higher price per share stocks, the notional value that each contract represents obviously is substantially larger. So doing a spread as a strategy does make sense. Tony, a couple of things that I've mentioned that I wanted to mention in observance of this particular underlying is that implied volatility on Meta is 27% annualized, and it is very close to its 52-week low. Obviously, your strategy is to sell this bull put spread. You're directionally bullish neutral, as you mentioned. You're obviously positive theta. You'll be benefiting from time decay if the underlying is going sideways, if it's going higher. But you're also negative vega in a circumstance where implied volatility is already scraping the bottom of the barrel in terms of its range. And so I was thinking, what this is telling me as a strategist is that you're more confident about the fact that maybe Meta in the near term is not going to go substantially lower, versus you being, more confident in the fact that it's actually breaking out and going substantially higher. Am I right there? What was the thought process?
Yeah, that's exactly right. Like I said, when we're trading in this range, the initial trade is not to play for that breakout. The initial trade is really just for it to stay in this particular range, and that's what the neutral to bullish nature of this put spread that we're selling. And you mentioned the fact that implied volatility is near the 52-week low, and that's absolutely correct. However, what I find that implied volatility rank or percentile doesn't give you a good sense for is really skew, and that's really part of also something that we're trading here. We're selling that 575 put, but at the same time, we're buying a 550 put, and the skew between those two options are important here. And the skew in this particular case actually still looks fairly attractive. That's why we're collecting nearly 40% of the vertical width on this $25 wide credit spread. So I'm still being able to reduce my overall risk. As you can see, my risk reward on a credit spread like this, despite the fact that implied volatilities are near 52-week lows, are still only about 1.5 to 1. A lot of credit spreads you sell, you might be risking $2 for every $1 you can potentially make, sometimes even risking $3 for every $1 you can potentially make. Here, I'm only risking 1.5, and that's an important element of this type of structure for me, is to try to reduce my overall risk relative to the total potential return on a trade like a credit spread.
Yeah, very good, Tony. I mean, we often quote the implied volatility 30, and obviously, implied volatility 30, 60, or 90 is looking effectively at the money option. So the put skew that you're alluding to is just the difference of implied volatilities of those individual contracts. And at the moment, it's not vastly large. So the one that you're buying is not substantially more expensive than the one that you're selling, that is closer to at the money on a relative basis. That's a very, very good point. Tony, I think we have a look back at a trade idea in a famous consumer discretionary stock. You brought this one up at the very back end of October. We were in one of these sessions together. This one worked out beautifully. What are we doing here?
Yeah, a few weeks ago, I laid out a bullish thesis here on Lululemon, and it seems to be continuing to do fairly well. We sold at the time the December 6th weekly expiration. We sold the 295, 270 put options here on Lululemon, was trading just above 295. Now it's trading just around 325 now, and the credit spread that we sold earlier at that time for about $9.40 is now trading at about a third of that, $3.65. So what I'm advocating that we do is we buy back that December 6th credit spread, and what we're going to do is we're going to roll it up and out to the December 27th weekly expiration and resetting the strike prices to the 330, 300 put spread. You know, we are widening out the spread here by about $5 to a $30 wide credit spread from before that was a $25 credit spread. And what we're doing is we're collecting another $12.75 by rolling it up to that December 330, 300. So my net credit on this overall is about $9.10, which brings my total net credit across both trades to about $18.50. So I'm selling this $30 wide credit spread, and my total credits that I've received is $18.50, which means that my total risk on this trade, even if Lululemon goes back below 300, which is my effectively what is my original entry point here, which I think the chances of that are relatively low now. But if it does, my total risk here is only around $1,100 versus the total that I've taken in, which is around $1,800. So I've turned this credit spread, which typically has negative risk reward ratio type of structure, into a trade that by rolling it now I have a positive risk reward metric on this, even in the worst case scenario where Lululemon goes back down below 300. But if it stays above 330 here by that December 27th expiration, I'm going to be total collecting closer to about $1,800 worth of potential profits per contract on this trade.
Very good, Tony. Today felt special. Not two trades, but almost three trades with this final roll in here. This brings us to a close. Wanted to thank all our viewers for attending. Want to thank you, Tony, as always, for bringing us fresh and interesting trade ideas. I would like to remind everyone, or take this opportunity to remind everyone in the audience, or notify you rather than remind, that the In the Money show is going to be taking a 2 week break. So the next episode that will be airing live would be on December 5th. Um, I'm looking forward to seeing everybody back here on December 5th, of course. In the meantime, don't forget that the Trading Strategy Desk, the team that I'm a part of, hosts a follow-up session to the In the Money episode every single week. It goes live on Fridays at 1:30 Eastern Standard Time, and you can sign up for it by going to fidelity.com/ in the money follow-up. You could also subscribe to our Fidelity Active Investor newsletter by going to fidelity.com/ active investor weekly. So plenty of stuff to look over and do in the next 2 weeks while we're out. Tony, it's great to see you. We'll see you back here on December 5th, sir.
Thank you, KV. It's been a pleasure to be here.